$38.4 trillion. That number isn't a projection. It's not a worst-case scenario. It's the official United States national debt as of this morning, January 1st, 2026, day one. And here's the pulse that should terrify you. We are adding $6 billion to that number every single day. Not every month, not every week, every 24 hours. The United States government borrows another $6 billion just to keep the lights on. That's $250 million per hour, $4 million per minute. You're watching the fiscal heartbeat of a dying empire, and the rhythm is accelerating. But before we perform the autopsy on what died in 2025 and what is about to collapse in 2026, let me pause for something important. To everyone watching this on day one of a new year, I wish you a 2026 defined by clarity and the wisdom to protect what you've built. In an era of systematic devaluation, may your purchasing power remain intact. May you see through the noise, and may you act while there's still time. Now, let's decode the collapse. Ladies and gentlemen, here's what happened while you were celebrating last night. While the ball dropped in Times Square and champagne was poured and resolutions were made, the United States Treasury crossed a threshold that cannot be uncrossed. The machinery of sovereign debt has entered a phase that economists call fiscal dominance. That's a clinical term for a very simple reality. The debt is now so large that it controls everything else. It controls policy, it controls interest rates, it controls your future. And the numbers prove it with mathematical certainty. I want you to do something right now. Pull up the debt to GDP ratio on your screen. You'll see it sits at 124%. That means for every dollar of economic output this country produces, we owe $1.24 in debt. Now, you might think Japan has higher debt to GDP and they're fine. But here's the critical difference. Japan owns its own debt. Japanese citizens hold Japanese bonds through their massive domestic savings. Japan borrows from itself. America? Well, we borrow from China, from Saudi Arabia, from pension funds in Tokyo and Frankfurt and Singapore. We borrow from foreign central banks who are now actively looking for the exit. And that brings us to the number that breaks the system. $970 billion. That's what the United States paid in interest expense in 2025. Not principal, just interest. $970 billion handed to bondholders just for the privilege of staying in debt. Let me put that in perspective. That number is larger than the entire Defense Department budget. We are now spending more money on interest payments than we spend on the military, veterans benefits, and homeland security combined. Look at your tax dollars. I need you to understand this viscerally. 1 in every $5 you paid to the federal government last year went solely to interest. 19%, not roads, not schools, not healthcare, not defense, just interest on old debt. You worked, you earned, you paid taxes, and a fifth of it evaporated into the bond market before it could do a single productive thing. In 2026, the Congressional Budget Office projects that number crosses $1,050 billion. We are entering the era of the trillion-dollar interest payment, the first time in American history. But here's where it gets forensic. Here's where we stop talking about big numbers and start talking about the trap. Because the real story isn't the debt itself. The real story is what happens when you try to refinance it. The United States doesn't issue 30-year bonds and forget about them. A massive portion of the debt is in short-term treasury bills. 3 months, 6 months, 1 year. And all of that debt has to be rolled over constantly. Like a credit card you can never pay off. You just keep transferring the balance to new cards at whatever interest rate the market demands. 5 years ago, the average interest rate on total marketable U.S. debt was 1.58%. Today, as of January 1st, 2026, that rate is 3.38%. It has more than doubled. And the Treasury is now forced to roll over trillions of dollars in short-term bills at these elevated rates. This is what the document I'm reading from calls the refinancing wall, and it hits in Q1 2026, right now. In the next 90 days, the U.S. Treasury has to refinance a staggering amount of maturing debt, and every single one of those new bonds will be issued at today's higher rates. Not the cheap rates of 2020 or 2021, today's rates, which means the interest expense you just saw, the trillion-dollar threshold we just crossed, that's the floor, not the ceiling. It only goes up from here unless rates collapse. And that's the trap. Because to bring rates down, the Federal Reserve would have to cut rates aggressively or restart quantitative easing. Print money, buy bonds, inject liquidity, the playbook from 2008 or 2020. But here's the problem. Inflation is still lurking. It's not hyperinflation. It's not Weimar Germany, but it's persistent, 3 to 4%. Enough to erode purchasing power, enough to terrify anyone on a fixed income, enough that the Fed should, in theory, keep rates elevated or even raise them to crush demand. But they can't. And this is where we perform the autopsy on the banking system. Open your bank app. I'm serious. Open it right now. Look at that clean interface. Look at your balance. Everything looks fine, doesn't it? Normal. Stable. But behind that screen, behind the teller counter, behind the reassuring logos and FDIC stickers, there's a $1 trillion hole. $1 trillion in unrealized losses sitting on bank balance sheets. Here's what happened. During the pandemic and the years before, when interest rates were zero or near zero, banks did what banks do. They bought safe assets. U.S. Treasuries, mortgage-backed securities, long-term bonds yielding 2%, maybe 3%, if they were lucky. Safe. Guaranteed by the government. What could go wrong? Then the Federal Reserve raised rates. Fast. Aggressively. From near zero to over 5% in less than 2 years. And when interest rates rise, bond prices fall. That's not opinion. That's math. If you're holding a bond that pays 2% and new bonds are paying 5%, your bond is worth less. A lot less. So now every major bank in America is sitting on a portfolio of bonds and mortgage-backed securities that are deeply underwater. If they sold them today, they would crystallize massive losses. But as long as they don't sell, as long as they hold them to maturity, they can pretend everything is fine. They can mark them at par value on their balance sheets and tell regulators, don't worry, we're solvent. This is what's called held-to-maturity accounting, and it worked great until people started asking for their deposits back. You remember Silicon Valley Bank, March 2023. A bank run triggered when depositors realized the bank couldn't cover withdrawals without selling those underwater bonds. The moment they sold, the losses became real. The bank collapsed in 48 hours. It was the second largest bank failure in American history. But here's what they didn't tell you. Silicon Valley Bank wasn't unique. It was just the first domino. The same unrealized losses exist across the entire banking system. Not billions, trillions. And this creates the trap within the trap. If inflation spikes in Q1 2026, if prices start rising again, the Federal Reserve should raise interest rates to cool the economy. That's Econ 101. But if the Fed raises rates, bond prices fall further. The unrealized losses at banks get worse. The risk of bank runs increases. The risk of systemic collapse increases. So the Fed is trapped. It cannot fight inflation without blowing up the banks. It cannot save the banks without printing money and making inflation worse. This is fiscal dominance. This is the endgame of decades of debt accumulation. And the market knows it. That's why, right now, on day one of 2026, every major investment bank on Wall Street has reversed course. Goldman Sachs, JP Morgan, UBS, Bank of America. Institutions that spent years dismissing gold as a barbarous relic, that mocked people who bought physical metal, that insisted the dollar was eternal, they have all issued new forecasts. JP Morgan, $5,055 per ounce for gold by Q4 2026. UBS, $5,000 by Q3. Goldman Sachs, $4,900 by December. Bank of America, $5,000, driven explicitly by, and I'm quoting the document, U.S. sovereign debt crisis and BRICS de-dollarization. These aren't fringe conspiracy theorists. These are the banks that run the system. And they are telling you in official research reports that the dollar is dying. But before we get to what $5,000 gold means for your portfolio, for your savings, for your survival in this system, we need to understand why this is happening. Because this isn't just about U.S. fiscal mismanagement. This is about a strategic countermove that's been building for years, and it's reaching critical mass right now. While America was borrowing $6 billion a day, while the Fed was trapped between inflation and bank failures, the BRICS nations were building an escape route. BRICS, Brazil, Russia, India, China, South Africa, plus the expanded members who joined in 2024. And they have formalized something that should be front page news, but has been buried under election coverage and celebrity gossip. It's called the Gold Strategy 2025-2030. And it's not about diversification anymore, it's about replacement. For decades, the playbook for central banks was simple. Hold U.S. Treasury bonds as reserves. Dollars were safe. Dollars were liquid. Dollars were the global reserve currency. If you wanted to trade oil, you needed dollars. If you wanted to settle international transactions, you needed dollars. The entire architecture of global finance was built on dollar dominance. But then something changed. The United States started using the dollar as a weapon. Sanctions on Russia. Freezing central bank assets. Kicking countries out of the SWIFT payment system. The Biden administration, the Trump administration, both of them discovered they could punish adversaries not with missiles, but with monetary policy. Cut off access to dollars, and you cut off access to the global economy. And every central bank on earth watched and learned the same lesson. If you hold your reserves in dollars, you are vulnerable. At any moment, for any geopolitical reason, the United States can freeze your assets. They can make your reserves worthless with the stroke of a pen. So the BRICS nations made a decision. They stopped buying treasuries, and they started buying gold. In late 2025, Brazil returned to the gold market after a pause, purchasing 16 tons in a single transaction. China continues to accumulate month after month, with official figures that analysts believe massively understate the total. Russia has been stacking gold since the Crimea sanctions. India, despite having a population that already loves gold culturally, is now buying at the state level. And here's what the document makes explicitly clear. These central banks are no longer just diversifying. They are replacing treasuries with gold as their primary reserve asset. The immediate 2026 target is to establish what they're calling a gold reference for trade settlement. Not a gold-backed currency yet, not a new Bretton Woods, but a system where BRICS nations can settle trade with each other using gold as the neutral reference point, bypassing SWIFT, bypassing the dollar entirely. Do you understand what that means? It means the largest commodity exporters, the largest manufacturing hubs, the fastest growing economies are building a parallel financial system. And they're anchoring it to the one asset the United States can't print, can't sanction, can't weaponize, physical gold. This is the de-dollarization consensus. And it's not coming, it's here, now. Here's where the math gets dangerous. Here's where we move from macroeconomic trends to the specific mechanism that could trigger a violent repricing in the next 90 days. Because while BRICS central banks are draining physical gold from the West, while institutional banks are issuing $5,000 price targets, something very strange happened in late December 2025. The price of gold dropped. On paper. Let me explain the disconnect, because this is the setup for what traders are calling the Q1 short squeeze. And if it plays out the way the data suggests, it's going to be violent. There are two gold markets, the paper market and the physical market. The paper market is where most of the price discovery happens. Futures contracts, COMEX in New York, LBMA in London. Traders buy and sell contracts representing gold, but the vast majority of these contracts never result in physical delivery. They're settled in cash. It's a casino where gold is the chip, but nobody actually takes the chips home. The physical market is where actual metal changes hands, bars, coins, central bank vaults, Chinese demand, Indian wedding season, industrial use. This is real gold moving from sellers to buyers who want to hold it. Normally, these two markets track each other pretty closely. But in late December 2025, they diverged. The CME, the Chicago Mercantile Exchange, raised margin requirements on gold and silver futures. What does that mean? It means if you wanted to hold a leveraged position in gold, the exchange suddenly required you to put up more cash as collateral, a lot more. This was an administrative decision framed as risk management, but the effect was immediate and brutal. Leveraged speculators, the hedge funds and trading desks who were long gold on margin were forced to liquidate. They didn't want to sell. They still believed in the gold thesis, but the exchange gave them no choice. Post more margin or close your position. Most couldn't post more margin, so they sold heavily. And the paper price of gold dropped into year-end. It looked like a bearish reversal. It looked like the gold trade was breaking down. Financial media ran headlines about gold's correction, about profit-taking, about momentum fading. But here's what didn't drop. Physical premiums. In Shanghai, the premium for physical gold, the extra amount buyers were willing to pay above the paper spot price, remained elevated. In the Middle East, the same. Central banks didn't stop buying. BRICS demand didn't stop. In fact, while the paper market was selling off due to forced liquidation, Physical gold was being drained from Western vaults at record pace. This is the disconnect, and it's massive. Smart money, the traders who understand the difference between administrative price manipulation and fundamental shifts, are calling the late December sell-off a bear trap, a false signal. Because the fundamentals didn't change. The U.S. debt didn't shrink. The interest expense didn't disappear. The BRICS gold strategy didn't reverse. The only thing that changed was a margin requirement on a futures exchange. And now we're in January. Traders are back from holiday. Liquidity is returning. And they're looking at the same math you and I are looking at, the refinancing wall, the $1 trillion banking trap, the de-dollarization consensus. Here's the trigger. If physical delivery requests on the COMEX increase, if major buyers start demanding actual metal instead of accepting cash settlement, the exchange has a problem. Because the ratio of paper contracts to physical inventory is estimated at 100 to 1 or higher. For every ounce of actual gold in the COMEX vaults, there are 100 ounces worth of paper claims. That works fine as long as everyone agrees to settle in cash. But what if they don't? What if a Chinese bank or a Middle Eastern sovereign wealth fund or a pension manager who just read the Bank of America report on U.S. sovereign debt crisis decides they want the actual metal? The short sellers, the traders who have sold gold futures, betting the price will fall, suddenly have to deliver physical gold they don't have. They have to go into the physical market and buy at whatever price they can find. And if everyone realizes this at the same time, if there's a rush for physical delivery, you get a short squeeze. Prices don't rise gradually, they gap, they explode, because sellers disappear. The people who have physical metal know the game is up, and they refuse to sell at artificial paper prices. They wait, and the shorts, desperate to cover their positions, bid higher. And higher, and higher. This is what happened to silver in 2021, but on a smaller scale. This is what happens in any market when the paper claims exceed the physical supply, and everyone realizes it at once. And here's why it's particularly dangerous right now. Silver. Silver is gold's volatile younger brother. It has industrial demand, solar panels, electric vehicles, electronics, but it also has monetary demand. And the silver market is much smaller than gold, much less liquid, much easier to squeeze. Independent analysts, including institutional research from J.P. Morgan, are projecting silver could hit $100 per ounce in 2026 if the industrial shortage collides with monetary panic buying. $100. Silver is currently trading in the 20s. That's a 4x move. Why? Because the same dynamics apply, but more extreme. The paper to physical ratio in silver is even worse. The COMEX silver inventories are at multi-year lows. Industrial demand is at all-time highs. And if gold squeezes, retail investors who can't afford a $2,000 gold coin will flood into silver. It's the poor man's gold. It's accessible, and it's about to become very, very scarce. So as we sit here on day 1, 2026, the setup is complete. The debt spiral is accelerating. The banking system is trapped. The Fed cannot raise rates without triggering bank failures. BRICS nations are building an alternative system anchored to gold. The paper market just experienced a forced liquidation that disconnected from physical reality. And the refinancing wall is about to hit in Q1. The base case, the scenario where everything goes relatively smoothly, where the Fed manages a soft landing and GDP grows at 2.6%, that scenario still produces $4,000 to $4,500 gold by year end. Because even in the optimistic case, central banks keep buying, real rates stay negative, and Western investment demand returns. But the bull case, the scenario that an increasing number of analysts believe is not just possible, but probable. The bull case is $5,000 to $6,000 per ounce, and it triggers not from good news, but from a credit event. A credit event. That's the clinical term. What it actually means is this: a moment when the market loses confidence in Western sovereign bonds. A moment when someone important, someone with billions of dollars under management, looks at the U.S. debt trajectory and says, I'm not getting paid back in real terms. It could be a failed treasury auction where the U.S. government tries to sell bonds and there aren't enough buyers at acceptable rates. It could be a major foreign central bank announcing they're dumping treasuries. It could be the BRICS nations formally announcing their gold-backed settlement unit, the one they've been building toward in the gold strategy 2025-2030. Or it could be the short squeeze we just discussed. A delivery failure on the COMEX, a revelation that the emperor has no clothes, that the paper gold market is a fiction, that there isn't enough physical metal to back the contracts. Any of these triggers forces the Federal Reserve into emergency liquidity measures, which is a polite way of saying printing, yield curve control, where the Fed buys unlimited bonds to cap interest rates, quantitative easing, helicopter money. Whatever name you want to give it, the result is the same. Dollars flood the system, and the value of each individual dollar declines. In that scenario, Western retail investors panic, not just institutions, not just central banks, regular people, retirement accounts, pension funds, family offices, anyone who understands that their purchasing power is being systematically destroyed. And they rush into the only assets that cannot be printed: gold, silver, real estate, commodities. That's the bull case. And the document I've been reading from, compiled from institutional forecasts on day 1, 2026, treats it not as a fringe theory, but as a legitimate scenario worth pricing in. So what do you do with this information? I'm not going to tell you to buy gold. I'm not your financial advisor. I'm a decoder. I'm showing you the system, the math, the trap. What you do with that information is your decision. But I will give you the framework that the smart money is using right now. First, understand the difference between wealth and currency. Currency is paper. It's digits in a bank account. It's subject to inflation, to debasement, to political decisions you have no control over. Wealth is purchasing power. It's the ability to acquire goods and services regardless of what happens to the monetary system. Gold and silver have been wealth for 5,000 years because they cannot be printed, they cannot be debased, and they are recognized globally. Second, recognize the timeline. The refinancing wall is Q1 2026, the next 90 days. If you believe the analysis we just walked through, if you believe the institutional forecasts from Goldman, JPM, UBS, and Bank of America, then the window for positioning at current prices is closing. Not closed, closing. Third, distinguish between paper and physical. If your strategy is to own gold, own the metal, not a futures contract, not a leveraged ETF that can be liquidated by a margin call. The whole point of the short squeeze thesis is that paper claims exceed physical supply. Don't be on the wrong side of that equation. Fourth, scale matters. In the base case, gold grinds higher to 4,500. In the bull case, it gaps to 6,000. The difference between those scenarios is not gradual. It's a phase transition, a regime change. If you wait for confirmation, if you wait to see which scenario plays out, you've already missed the move. That's the nature of asymmetric bets. You position before certainty, not after. And fifth, this is not about getting rich. This is about not getting poor. The debt spiral, the interest expense consuming 20% of tax revenue, the $1 trillion banking trap, these are not problems that get solved. They are problems that get inflated away. Your job is to ensure that when the inflation comes, when the printing presses run, your purchasing power is preserved. 2026 is the year the math stops working, the year the debt trap becomes undeniable, the year the BRICS alternative becomes operational, the year the market reprices the dollar, not for what it is today, but for what it will be forced to become. And you now have the data, the $38.4 trillion debt, the $6 billion per day addition, the $970 billion in interest expense that crosses $1 trillion this year, the 3.38% average rate on a refinancing wall, the $1 trillion in unrealized banking losses, the BRICS gold accumulation, the paper physical disconnect, the institutional capitulation to the $5,000 target. This isn't prediction, this is forensic accounting. This is what happens when a debt spiral meets fiscal dominance meets a loss of global reserve currency status. The system has been decoded. The autopsy is complete, and the patient died in 2025. We're just waiting for the market to realize it. If this analysis gave you clarity, if it armed you with information you can't find in mainstream financial media, then keep the system decoded. Subscribe to this channel, hit the notification bell. Because 2026 is going to move fast, and you need to stay ahead of the narrative. Share this with someone who still thinks their savings account is safe. Share it with someone who doesn't understand why gold is hitting record highs. Share it with anyone who deserves to know what the institutions already know. And remember, this is not financial advice. Gold, silver, and all markets are volatile. You can lose money. You must do your own research, consult professionals, and make decisions based on your own risk tolerance and financial situation. But the math doesn't lie. The debt doesn't lie. And the clock is ticking. Stay decoded.